comparable property.
I'm sorry. I had to turn on the recording. I was about to get yelled at by Kathy and stuff. So I'm sorry. I had to turn on the recording.
Yeah, so like, in your communities, they're having like, anywhere from 60 to 65 comparable properties on the market, which is much more than we've been seeing in the past couple of years.
Yeah,
And they're
absolutely.
taking longer to go under contract as well.
Yeah, like I think those are a lot of things that Angela talked about. There are things that a lot of agents are telling me right now, right? Like we're starting to see inventories start to add up, right? So things are taking longer. And these are all precursors, right? Real estate is generally a lagging indicator of what's going on in our economic cycle. And even though, like as you see from this sheet here, right, mortgage dominates household debt by far, but stress on consumers and stuff can show up first in like revolving debt and autos, which is why we kind of take a look at this. So a homeowner can be current on their mortgage while their monthly financial margin is eroding everywhere else. And that's why you're starting to see consumer debt and stuff increase pretty drastically here. And so the car payment, right? This is a signal for us at this point. And auto default loans right now are at an all-time high. And there's a lot of headlines and stuff out there on this, but they're talking about like what that people will fight like hell to keep their house, but then this financial stress that we talked about shows up somewhere else, right? It shows up on their credit cards. It shows up on them falling behind on auto default loans. And again, we're only at like 4.7% delinquency amongst all of those things right now, which is not crazy. It's a little bit higher than what we would say a normal indicator is. But again, these are just things that we need to look at, right? $1.7 trillion in default loans. The prices that some people are paying for auto loans are as crazy to me at this point in time. Thousands of dollars in auto loans and stuff like that. And so when things start to get tight, people will start strategically peeling off some of their bigger obligations and stuff there. So early auto delinquencies and stuff are just something that we need to look at. But then the last one is also a leading indicator for us, is that the median score on newly originated auto loans fell by 7 points. Well, what does your credit card like some participation here? What causes your credit score to decrease?
Like mortgage payments.
Like mortgage payments, like car payments,
Debt to
phone
income
payments,
ratio, debt to income ratio.
debt to income ratio, right? Like you keep stacking this debt and you're not making more money at the end of the day. Yep. Balances, right? How much you have on each of your credit cards, right? Because as your debt starts going up on those credit cards, they say, oh man, Kelly is spending a lot on his credit card. Let's reduce the limit, right? And now it shows that your credit cards are maxed out and stuff like that. All of these things are really important. So the fact that credit scores decreased by 7 points, that's kind of a big deal. And again, just a leading indicator and stuff right now. And what's happening with interest rates? Are they up or are they down right now? And that was kind of a facetious question, right? Because they're way up over the last 3 or 4 years, which is also making it cost more for the products for like houses and cars and stuff that we've been buying over these years. So again, just some leading indicators that you guys need to know about and that you guys need to pay attention to for yourselves, for your clients and stuff. So that way you can help people out of this. So real estate, as I mentioned, is often the lagging indicator. People protect the roof over their head. That financial stress can appear in cars, auto loans, spending behavior before it ever hits the mortgage payments at the end of the day. And this is the framework, right? This isn't a claim that a national foreclosure wave is already here, but I was on a mastermind call yesterday with Leo Pareja, who is he's the CEO of EXP, one of the most brilliant minds I've met in real estate, right? A lot of you guys, if you're on the East Coast, know him because he sold over 4,000 REOs with his team in the past. He was Fannie, he was Freddie. He has been brilliant in everything that he's touched at this point in time. And this was his words yesterday on the mastermind, right? It wasn't that winter is coming. It was that winter is here. And he was talking about this from a perspective of agents' production right now, is that the average agent's production is down. And I don't want any of you guys to be down. I don't want any of you guys to be average, because I've seen what the average NAR toll numbers and stuff are. And that's terrible. I don't want any of you guys to live with that, live like that. And so I want you guys to be able to help as many people as possible, guide them through, this financial decision with the largest asset that they've ever owned, and then create these raving fans so that way you guys can have some clients for life here. But here's the thing. This is also what I want you guys to realize and what we're talking about. And we're just kind of laying the foundation and stuff right now. But by the time that everyone agrees there's a real estate problem, it's already too late. And that's why I brought up what Leo said yesterday. It's not that winter is coming, winter is here. By the time everybody figures out that there's a problem, the agents that prepared for it already are 6 months ahead of the game. Then it takes everybody else so much more time. You guys have relationships. You guys have built this, which is why it's so important for you guys to get out there and network and go to these events like 5-Star and REOX and NADP. If you want to position, if you think there's going to be opportunity in this banking side of things. And I can tell you just from some of you guys on this phone, like when there's not supposed to be REO, it's exploding for us right now. Kelly Cummings, you mind? How many REO listings do you have right now, my friend? Like from pre-list to active to pending?
62.
62. Guys, I haven't heard numbers like that in a long time, right? And like we're part of some of the same networks and stuff here. And like, man, I think Jeff and Kelly have close to 30 listings. Now, those are also expired FSBOs and things like that. That's not just on the default side of things, but we're starting to see some of these things start to pick up more and more and more. All right. This was super interesting to me, is that over the this is from a news source here, but August 18th, right, which was not too long ago, earlier this week, they're estimating that there's 16 to 20 billion dollars in net shorts on the NASDAQ right now, right? 16 to 20 billion. And this came up to me because I follow Michael Burry, who the Big Short was created after. And his fund just bet a lot against the NASDAQ. Okay. So that is one thing that like these funds, like these hedge funds, wealth management funds, etc., have increased their number of shorts in the market. A lot of them are around the AI industry and stuff right now, artificial intelligence, right? Because they're not essentially making money. It's this future vision and stuff like that from the articles and stuff that I was reading this morning. And so this, right, they're increasing their shorts. 44% of institutional filers trimmed like from the Magnificent Seven, right, which are the largest companies and stuff that are out there, which is where they've made a lot of money. So here's the thing: big money isn't universally bearish, thinking that it's going to crash, but they're hedging their bet. That is what they're doing with these shorts and stuff to protect everything that they've been able to build at this point in time. And so your client doesn't need to own NVIDIA directly if that stock goes down to be affected by this. if your clients are like some people are like, oh, well, I don't do much in the stock market. But here's the thing. This is what a crash or correction or something like this with Wall Street does to us, is that how many of us have 401ks or wealth accounts or retirement accounts? All of that is tied to companies there. And so what it does is it sucks liquidity out of the market, right? We saw this in 2007 and 2008, where people were getting ready to retire, and all of a sudden their retirement fund, their 401k was cut in half just like that. So that's the first thing, is it sucks liquidity off the market in a hurry. Leo Pareja was talking about this, where he'll be up 8% as far as AGNT, right, which is EXP stock. It'll be up 8% and then down 4%, right? There's these huge swings in the market and stuff right now. Well, look, when that happens, consumer confidence, right, and discretionary spending start to go down. People start to get worried. So they start pulling even more money off of the table because they're not sure what's going to happen. And then once that happens, right, now we're just sucking all of this liquidity off of the market. And so now that companies are making less, right now there's hiring freezes, there's layoffs, right? Anybody, a show of hands or in the chat box, right? Anybody know a client or friends or family that have been laid off in the last couple of years, right? Like, or they graduate from college, they can't get a job. So if the stock market starts to fall, all of these things will be ways that your clients can potentially be affected at this point in time. And now if we have less, now we have less money for a down payment. There's less move up demand, right? All of these things can affect us and our clients out here as well. So here's the other part of this, right? Is that, what was this? I'm trying to remember what this article was talking about here. So I know we're going to get into the different housing rules and changes and stuff like that. But one of the things on this side is that a lot of how many of you guys have worked with hedge funds, acquired investment properties for investors and stuff like that since 2020? Okay, I see some hands. How much of that business how many of you guys that have been working with those people, that business has decreased? Right? Like almost every person. Now, that's not saying that there's no buyers and stuff anymore. There's still people buying American homes for rent or this or this or this. But it's in a different arena. And part of that is because Washington went and changed the housing rules. And this was big. In January, the White House established a policy that large institutional investors should not buy single family homes that could otherwise be purchased by families. And that is a major change in this political environment that's surrounding this institutional SFR space. So with that, how many of you guys work with Tricon? A couple of you guys. So we saw this, right? Like where they essentially stopped selling, right? And now they're starting to pick back up and stuff again, right? Because they're evaluating this market and stuff right now. And so you've seen that, and I don't think it's just this ruling, but it's also interest rates. Their money is not as cheap and stuff as well. And so you're seeing a lot of pressure on some of these funds because of some of these rules. And now you're starting to see some liquidation in those portfolios and stuff as well. Again, this isn't good. This isn't bad. These are opportunities if you want to work with those clients. These are opportunities. Well, how do you get these opportunities? You have to build relationships with these people. And that's what going to, these different conferences and being on their webinar calls and stuff will do for you, is helps you to build that relationship when they need you. And here's the other thing, right? Like, even with that being said, some of these hedge funds were starting to expand across the country, but this study, this GAO study that I was looking at, the majority of institutional investors are only in 6 major metro areas: Cincinnati, Dallas, Jacksonville, Nashville, Seattle, Washington, and I know Atlanta's in there and stuff as well. But that's where the majority of their portfolios are handled right now. And at some point, like you heard these alarming stats that like, oh, they own 30% of a market or this or that. I have not been able to verify any of that. With everything, we're seeing that institutional investors own 1 to 3% of properties. Now, they were also buying, though, in the areas where your first-time home buyers were doing as well. So that created a lot of competition and drove up the price. So could this help kind of bring some of those first-time home buyer values and stuff back into affordability? Potentially, right? We're going to have to see where that goes. But a big part is that they held 4 to 22%. And so a lot of them are shifting into rentals or starting to liquidate and move their money at this point in time. So as we said, this isn't everywhere. They are concentrated on the Sun Belt, say California through Texas, all the way over to Florida, and then a few other local metro areas at this point in time. So it's very concentrated, and a lot of you guys, just because I know your guys' business and stuff, are in some of those markets. And so again, there's opportunities for buyers, for sellers, to help them with their rental portfolios, etc. Now, this will be important. What the funds do next, right? So institutional owners can dispose, right? Like they can do a lot of things. And I'm not saying that they're dumping, right? They're not dumping their portfolios and stuff like that, but they've been buying since 2010, 2011, because money was near free. They have a lot of margin on this. And so like they have a big opportunity here. And naturally, these guys are constantly moving their money, looking at what's next. They have aging portfolios that they like to turn over and stuff there. And this is where I just want us to follow what they're doing, because if you're in some of these markets and they're starting to do disposition, it's going to add months supply of inventory into your particular markets. This is really important for traditional listings, right? Those people that want to list here and then it's just sitting, you have to educate them. Frida had mentioned, people are just sitting on the sideline to wait for the market to come back. That statement scares the hell out of me, guys, because if this market continues to go down, that's when those folks where they could have actually made $20,000 or $30,000 proceeds right now, where that starts to go down to where they're breaking even. Oh no, I'll wait for it to come back. And now they're in a short sale. They're in a foreclosure situation because the market's depressed. Liquidity has been taken off the market. That's what I'm talking about when you follow the numbers and see how the entire cycle kind of runs together. That is what we're talking about here today. And so, the economics have just changed over the last couple of years, right? We have higher home rates for homeowners. So that brings up, there's been higher prices, higher interest rates. The rental growth has slowed for a lot of these funds, which is why they've become a lot more selective at this point in time. So they're still going to be here, but they have harder acquisition math. The buy has to be perfect when the market starts to level out or even go down. There's always good opportunities to buy and invest for you guys and for all of your clients and stuff like that, but the math has to be really right. If you bought in 2021, 22, I'm not saying you couldn't make a bad buy, but you had to really try at that because the market was appreciating and stuff so much. And so this is where we're going to kind of pivot from this macro fear to like, what can we do as agents, right? Because the goal is to show like where the transaction flow can kind of migrate if households or capital market pressure continues to rise. Look, you already heard it with Jeff and Kelly. Traditional, motivated seller listings. What was the key word there? Motivated, right? This is where you got to pre-qual your client. The pricing is going to be more important now than ever before. For all of my REO agents, your BPO and valuation is going to be so much more critical, right? The margin of error is going to be lower, and they need a professional to be able to evaluate what's going on, where the market's going. And you have to be brutally honest with them, right? Well, can we list it for this? You can list it for whatever you want. Do you want to sell it? You're going to have some hard conversations with your clients and hold your ground. If you think that home is worth 400 and they're saying we want to try 450, like create a plan. Okay, if you don't have X amount of buyers through your property in the first 2 weeks, can we reduce the price? Because I'm scared that you're going to be trailing this market. And if we don't list at 400 now, it's going to be 390, 375 and stuff in the future. So if we don't get the traffic and attention at 450, are you willing to do this? Like, you guys are going to have to be the professionals in this next market here. So this is where, right, this debt moves to distress, turns into disposition, turns into opportunities. So we're always going to have traditional motivated sellers, bar none. BPO valuation work on your own REOs. And how many of you guys do BPOs and valuation work for fees and stuff right now, right? I know a lot of agents that make thousands of dollars a month just doing BPOs and valuations. And it's helped save them when sales and stuff are down, all by helping them evaluate more property. So I think that's a huge opportunity. Institutional dispositions, absolutely, right? This is where I think in our REO Alliance, we're up to 12 different asset management companies now, talking to 2 other institutional funds. One of them has over 2,500 homes under management, and their goal is to be at 5,000 homes. I want you guys working with those clients before they get busy. I want you guys positioned ahead of this next market, because we've been going up since 2008, 2009, pick any of those dates, 2010, I don't care. That means we're 16 years into an upward trend. Guys, our average cycle is 8 to 12 years. That is our average cycle. We are already overdue. I think that we should have had some shifts and corrections in 2020, but COVID hit. We pumped trillions of dollars into the market, and we sent every asset class parabolic. Look, this is where I hope all of you pulled some money off of the table. You guys are playing with house money and stuff, but now we got to look at what's coming next down the line, right? Michael Krein and Bubba Mills, and like every big person in the REO and default space right now is preaching about short sales. We just had 2 weeks ago, Denise on, who's a short sale negotiator. I don't recommend that you guys do short sales. I recommend you know enough to educate your people, but man, the liability on a short sale and trying to negotiate somebody else's debt when you're not like an expert in that area scares the hell out of me. And it also scares the hell out of me that a lot of people are getting these short sale certifications, and then it gives us kind of this false bravado, right? Like this false confidence, like, oh, I'm short sale certified. Let me go do this, right? Like, there is so much to it. So the short sale negotiator that I have on never got out of the business. She negotiated thousands of short sales. It doesn't cost anything out of your commission. She knows each of the banks. That's where, look, you continue to go out there like Jeff and Kelly and get more listings, have somebody else do the negotiation, capture the paperwork, take on the liability. But that's going to be a huge part of it. It's conference season right now in the REO space, right? So we have 5-star, and then I think we have NADP, and then REOX coming up in November and stuff like that. I'll be at NAD, I'll be at all of them. I'm speaking at NADP and I'm speaking over at REOX and stuff as well. So if any of you guys are there, I want to see you. But the REO and default servicing side of things, like all of our clients are starting to see this pickup. And you got to think that when COVID came along, we stopped foreclosures. So defaults have been the lowest they've ever been at this point in time. But all of these things could amplify and really have this waterfall effect. And here's the other part, right? Assumable loans. Guys, this is such a huge opportunity. I know Kelly Cummings has 900 something leads from his funnel pilot system and stuff. Like Kelly, imagine if you looked at all of the assumable loans in Mobile, like from Assume List, who we had on a few weeks ago. Imagine if you found assumable loans in your area and you reached out and you were like, Kelly, I know we were looking at new homes or this or that, but I found a home that was 5 years old and it has a 2.79% interest rate that you could assume. With that interest, how many more conversations could you guys get into? Would that get a buyer off the fence? This is where we start to be compensated by solving people's problems, guys. And as this market shifts, there's going to be more problems that we have to solve at this point. And so again, I don't think this is good or bad. I think this produces a ton of opportunities, and the agents that, you know, oh, that's not the way that I do business, like they might be out of business in the future unless they can really carve out a niche and make something out of it. So you don't prepare for REO when the signs start to go up. And that's where, man, so many of you guys, I'm blessed to be alongside of you guys. I learned so much from you guys at this point, but we never got out of it. We've just been collecting all of these relationships now for 17 years, continuing to reach out, continuing to add value, right? So, you know, as consumer stress is rising, affordability is still being challenged. These institutional strategies are changing. Capital markets are hedging the entire NASDAQ at this point. The housing policy is shifting. Servicers are preparing through these pre-approved short sales. And asset managers are starting to build their networks. Do you want to be in their networks? Because now is the time. It's not when default ratios are 6%. Are 8%, etc. And people see that REOs are being listed as the best prices, and those are selling over the traditional homes. It's too late because rock stars like you guys have already positioned for that next market. So this is where you guys have to know servicers, meet servicers, asset managers before the inventory rises. I know Kelly and Jeff do a mastermind. I don't know if Wendy Martin is on here, but I know she does a lot with REO rock stars at this point. You have to know, like, you have to have some competency in the BPO side of things. That's probably one of the biggest pieces of the REO process. It's getting that evaluation, learning how to talk with the asset managers through those forms. That's their love language, right? That data is their love language, and you got to know that. You have to track your own local delinquencies, investor ownership, and inventory, because everybody on here, every market is a little bit different. Start building this database, right? Again, we had Assume List on here, which is a database. Like, you can literally pull up your market and find every assumable loan in your area. Imagine if you get a buyer lead. That's a different conversation. Right? Oh, well, I'm talking to a couple of other agents. Oh man, have they showed you how you can get a home at a 3% interest rate? Huh? Adds so much value to the other side where it is a disservice that they don't do more business with you. That is what I hope, right? Become that agent who understands both retail and default. Use this next 4 to 8 years to set up the rest of your lives, to set up your database, to build a group, to build a team, to build a business that continues to make money whether you go to work or not. this will be the time because of how many opportunities will be available and stuff to us. So this is not fact or anything like that. This is my 12 to 24 month thesis here, is that there is going to continue to be more financial pressure, bar none. Our institutional capital is going to be much more selective, and they're going to have to buy right, and they're also going to have to sell right, which is going to produce opportunities. There is going to be more portfolio rebalancing and dispositions. I don't think it will look the same as last market. We're already seeing, like PIMCO is one of our clients and family friends over here. They are bidding on over 5,000 homes in a HUD auction. HUD used to be their own asset management company, right? Like HUD used to manage all of that themselves. Same with Fannie, same with Freddie. You're seeing those default portfolios being sold off at this point in time. PIMCO is going to need better qualified agents, a bigger network and stuff there as well. More valuation work and motivated sellers. Again, like there's a big opportunity to build a business and stuff on that side. And then localized distressed rather than necessarily like a 2008 style national collapse. There's going to be market specifics. There's already some markets like in South Florida that depreciated over 20% last, like year over year. Right. And that's not one, that's due to the people that are migrating there, moving, the expansion of growth that they had. So now there's all of this inventory and stuff on the market. That's insurance patterns that they're watching. Some homes don't qualify for insurance anymore. People have cut them out. And then the condo laws and stuff have changed as well. So this is already happening, but you have to know what's going on in your local market explicitly. So I don't need to predict a crash, right? I want all of you guys to be positioned for more friction, for more motivated inventory, for more institutional rebalancing. And that's where I want all of you guys to kind of focus on at this point. So position, don't predict. Right? Like it doesn't matter what the market is, you can capitalize on it. In an up market, man, listings and buyers are gold. In a sideways market, listings and investors are gold. In a downward market, BPOs, short sale, REO, investors, right? Rate relief, right? Like if insurance or mortgage rates start to drop, right? More motivated buyers, those move up sellers at that point, that's where we can recapture no matter what's happening in this market trend at this point. So build a business that wins in every one of these lanes, right? I don't care whether the next 24 months gets called a recession, a correction, normalization, or a transition. I really don't care where the inventory comes from or who controls it. And I just want all of you guys to be positioned to be able to figure out if it matches with your business plan that you guys are ahead of it. So the broader opportunity beyond REO is going to be motivated traditional sellers, investor dispositions, BPOs, REO, short sale, assumable mortgages, and buyers. I don't know if you guys can capitalize on all of those or not, but pick 3 or 4 of those and become really focused on that. Build a plan and stay in front of your clients and stuff at this point. So that's what I got today, guys. I just want you guys to be very aware of what's going on in the market, like, and how you position for that. I don't know when that market's going to be here. I don't have that crystal ball. I wish I did. I just don't have that ability at this point in time. But I can tell you that things are shifting really quickly, and that's where you guys need to be positioning and stuff on that. Questions, comments, concerns from anybody? Can I get a short sale negotiator info, please? Jennifer, do me a favor, just shoot me an email and I will get that over to you. I don't have it off the top of my head and I don't want to forget. I appreciate that, Joe. Yeah, there's a lot of info and stuff, and we didn't deep dive, but I just wanted to, again, kind of give a broad level overview, and then whatever part of the market that you guys want to focus on, start digging into it. Start learning more about it. Anybody else? All right, guys. If how many of you guys are going to 5-star? Raise of hands. 3, 4, 5, 6. Beautiful. If you guys want to go, that is in Dallas. It's coming up quick. It's August 31st, 1st, and 2nd. We have a discount code, REOA100, that I put in there if you guys want to go. This is where all of those potential default clients and stuff will be, right? Like this is where you meet them. This is where you spend time with them and stuff like that. You want to do it now while there's 1,500 people at the conference versus, 15,000. I'm being a little facetious at this point in time, but like, again, a lot of us were at 5-star when there's 4,000, 5,000, 6,000 people, right? Like that's not when you want to go. You want to go now before everybody else. Angela Filkins, what do you got?
I was wondering, the membership with REO Alliance, I mean, he sent out emails about that, but I had already registered for the 5-star. So if when I went to click to, do the $300 membership, I would have had to pay for the whole 5-star again. So how do I sort that out?
Angela, I just went through that, and I did talk to someone at 5-star. So I'm joining the force because she explained to me it's more for seasoned REO agents. And I told her that I'd already paid, and she said fill out the application, and that $495 or whatever you paid will be reimbursed. So it's
Okay.
only going to cost me $1,000 to join.
Thanks,
Yeah,
Debbie.
because yes, thank you so much for that, Deborah. When you're a member of the force, you get to go to the 5-star conference for free, correct? And some of the other events and stuff like that. So essentially, your ticket is paid for and stuff there, and you get other perks of being in that community and stuff as well. But thank you for that, Debbie, because I was going to have to reach out to other people, so I appreciate it. Anybody else have anything? There's also NADP that's going to be in Tampa, Florida, and then REOX is coming to Fort Worth area the beginning of November. I think the 9th, if I'm not mistaken, of November. But that's all I got for today, guys. If you have any questions, need anything, call, text, or email me. I am here for you guys. I appreciate you, and I'll talk to you soon. Have a great day.